Intercompany inventory transfers. We're going to continue with upstream transactions. And just as a reminder, the recordings include only the intercompany transfer information. The lecture notes are a little bit more detailed. Alright, let's continue with case 2. Subsidiary buys the goods from a third party, sells them to the parent, and the parent later sells those goods in the succeeding year, not in year 1. Okay. We're still concerned with the equity method of accounting, but we're going to add one layer to it this time, and that is going to be any special allocation items we may have for deferred gross profit. Here are the inventory sale information. Similar to case 1 on the upstream transactions, we'll continue with this information for consistency. So we'll compute the markup on cost, and by following the markup on cost formula, we can determine that the gross cost of goods sold is $59,000. So the subsidiary will make the following entry when they buy the inventory. They will later make the next entry here when they sell to the parent. And then the parent will make this entry when they buy it. This is similar to case 1. This is where we have a difference between case 1 and 2. In this case, the parent did not sell any of the inventory in X1, but sold it in a later year, X2. Again, we have to determine, is there any deferred gross profit? Is the gross profit under or overstated? And again, notice we're not asking if it's the parent or the subsidiary. We're just asking, in general, is it under or overstated? And in fact, we know that it's not correct. So what we know is the following from our inventory transfer worksheet is that the revenue for this transaction was 94, cost of goods sold was 59, and a gross profit is 35. So we ask, is this correct? Can we recognize it in the X1? And we know from the information that the parent has not sold any of the goods, so we must defer or postpone all of the gross profit from the transaction. And if we follow the inventory transfer worksheet, the bottom right hand corner will tell us the deferred gross profit amount, and the entries above will tell us the intercompany transfers. Again, the revenue will eliminate that, and then the values in the ellipse will total those up for our cost of goods sold entry when we do our EJEs. Alright, so how do we handle this under the equity method of accounting? Again, the parent is aware of the transaction with the sub, and they have to account for that whenever the transaction takes place. So what we know is this, that there's $35,000 of gross profit that is deferred. The question is, what do we do with it? This is an upstream transaction. The sub sold it to the parent. So the gross profit of $35,000, the parent cannot recognize all of that deferred gross profit because they do not own 100% of the subsidiary. They only own 80%. So we'll debit income from sub for $28,000, 80% of $35,000, and credit the investment subsidiary for $28,000. And again, we ask where the transactions start. If it starts with the subsidiary, the parent has to allocate it out. If it starts with the parent, it's 100% for the parent. So what we'll do when we do our income reconciliation is that the $35,000 deferred gross profit will be allocated out between the parent and the NCI. And you can see that here. We'll come back to this $35,000 of deferred gross profit when we prepare our consolidated income statement. We always record any equity method entries in the investment sub-account. And of particular note here is the deferred gross profit. And we'll do the same thing for the non-controlling interest. Again, these won't come from the equity method entries, but they'll come from the EJEs. Let's do the consolidation for X1. We'll pick up with EJE number 4, the special allocation or the deferred gross profit. And we ask ourselves, just like we did in the downstream transactions, what did we do during the year? This is the entry we just made, so we must reverse this out. We have one more step that we must do, though. We must reverse out the equity method entry, and then we must also assign the non-controlling interest their portion of the deferred gross profit. So what we're going to do is the following. We're going to have a compound entry. The compound entry will include the reversal of the income from the sub, and it will also include assigning the NCI their portion of the deferred gross profit of $7,000. EJE5, we must properly state the revenues and expenses, and just as in the downstream transactions, we'll get this from the inventory transfer worksheet, and it'll come from the following. And after these are posted, it'll look like this. But here's the entry here. Debit revenue for $94,000. Credit cost of goods sold, which is represented as 0 plus $59,000 from the ellipse. The inventory is a credit of $35,000, which is the deferred gross profit amount. As you can see here in our consolidated statement, we have 0 revenues and 0 cost of goods sold, which we should because nothing has been sold to third parties. And then lastly, our inventory is stated at the cost that the subsidiary paid for it when it originally bought the goods, $59,000. In our consolidated net income, we will add or subtract any deferred gross profit. In this case, we'll subtract it out, and we'll put that under the subsidiary's information. Let's complete the transaction and look at the activity for X2. We still have to address net income, dividends, and any deferred item that we may have. In this case, we know that the parent has later sold those, so we will have to recognize any deferred gross profit that we've postponed. So let's complete the transactions in X2. Parent sells the goods to a third party for $135,000. Here are the 2 journal entries for that sale. What we know is the parent has the following information on their income statement. But what about the subsidiary? We postponed $35,000 of gross profit last year. We need to incorporate that in to our consolidated numbers, and by crediting the cost of goods sold, we incorporate that number in. Since the subsidiary's gross profit is understated, we're going to remind the parent, hey, we've got some deferred gross profit here, we need to state it properly. So we're going to end up with an equity method entry that's going to look like this. In year 1, we debited to the income from sub since we postponed it. In year 2, we're going to credit the income from sub to recognize it in income. But again, notice that the parent only gets 80% of that deferred gross profit of $35,000, and that's $28,000, and you see that in the entry above. You can notice here that we add this to our income in the second year. And again, we're posting all of our equity method journal entries to the investment sub, just as we're posting all the EJEs to the NCI. All right, what do we do for consolidation? EJE4, again, just as we did in year 1, what do we do during the year? This is the equity method entry we made in X2. We need to reverse it out. If we do not reverse it, we're left with a debit of, or credit here of $28,000 in consolidated net income. We must get rid of it, and we must also assign the NCI their portion of the item. So what we're going to do is, again, we'll have a compound entry, and this is what it'll look like. All right, let's take a look at EJE5. This is going to be a little bit different than we saw in case of 1. So watch what we're going to do here, and this is going to be a little different than we did on the downstream transactions as well. We know we've got the deferred gross profit of $35,000 to address, but we always know in X2, if we have a balance sheet account, we're going to ask, what do we do with it? We've got to address it, at least think about it in the second year. So we ask the question, where do revenue and expense accounts go when they close out? We know so far that it's investment sub. But let me ask you this. Let me back up a couple slides here. On this revenue, does the parent get 100% of that revenue since it's an upstream transaction, or do they have to share that with the NCI? They have to share it, as well as the cost of goods sold they have to share. So what we're going to do is we're going to close out revenue and expenses to the investment sub account, and we're going to close it out to the NCI. So if we start with our X1 entry, we're going to have to modify it to incorporate the revenues to investment sub at 80% and NCI at 20%. We'll do the same thing for the cost of goods sold. And we're left with the inventory account. Can we use that inventory account? Well, we have to say no. That inventory has been sold, and that deferred gross profit, which is what that is, can now be recognized. So we're going to credit cost of goods sold there. And as we clean this up, it'll look like this. And with our partial income statement, we see that the revenues reflect revenues to third parties. The cost of goods sold amount reflects the inventory that remained at the end of X1 at the actual cost we paid from third parties. And just like we allocated all of the deferred gross profit, we subtracted it in X1, we're going to add it in X2. This concludes our discussion on the upstream sale of inventory for case 2, where the parent sells some of the goods to third parties in the first year and some of the goods in a later year.